Welcome back for this second afternoon of Paris Math. We'll start with a round table on pricing, eagerly awaited. We have many speakers around the round table, and they'll be talking about this topic. Sylvain Gaudin, hello. Sylvain Gaudin, you'll be moderating this round table. You can introduce your speakers. Sorry, I got lost there. You are Chief Underwriting Officer for Marine and Energy. Hello, everybody. I'm very pleased to be with you here today, and I want to thank the organizers for having entrusted me with this task. I have to keep you awake this last afternoon of Paris Match. The countdown of participants, I hope, will no doubt be favorable. We're going to talk about the construction of pricing for insurance companies. It may seem boring, but it lies at the heart of our work. It's not just a stylistic exercise to satisfy keen people. It is the very hub of insurance and reinsurance. You can model risks, measuring exposure and the cost of capital. A good model, a holistic model, makes it possible to meet ever more stringent regulations and guarantee the solvency of companies. Pricing is indispensable in terms of offering the right protection based on the right pricing of risks. We'll be talking about the fundamentals of pricing. It will be educational to start with, and then we'll have exchanges, a debate, and we'll be able to answer any questions which we hope you will send in large numbers. At the end of the session, you'll know everything about pricing, the purpose, how it's done, its past and future. We'll look at pricing 2.0, artificial intelligence, and various models. First of all, you get a theoretical course developed by Laurence Mariani. Laurence is an engineer by training, and currently she works for AXA XL since 2017. And Laurence, you work in risk management, pricing, inter alia. Alex Wong, to my left, helped also to put together these slides. He is an actuary. He belongs to the Institute of Actuaries. Alex began his career with AXA Global Way from 2014 to 18. He currently is senior pricing actuary with SCORE since 2018, in fact, and he has great experience in many business lines, including marine insurance. I'd like to thank you both very warmly for all the work you have done building up this course. And then in the second part of the roundtable, we'll talk with Frédéric. Hello, Frédéric. Frédéric Jousse, who for over 20 years has run international development at BICI. He's been involved in any areas, shipbuilding, ship owners, logistics experts, and he has a very cross-cutting activity and is developing international business. We will be answering questions, offering various solutions. How do you think about buying an insurance? How do you size up overall risk? Can one have a common understanding amongst insurers, reinsurance, customers, and the way everything should be priced? I'm sure we'll also get many questions from the audience. Please start sending them in via the chat. Without further ado, Laurence and Alex, you have the floor. We're going to start this presentation. As Sylvain explained, it's going to be a bit like a lecture, a course, going through the basis of pricing in insurance. And gradually, we'll establish a link between theory and practice, in particular by explaining why we need the data we ask for from our customers, what they're going to be used for in our model, and how can we apply these data. General introduction here. In terms of the coarse side of things, we thought it would be good to talk about what a price is in insurance. A price is exactly the same thing as for any kind of industry. You have fixed costs, you have regulatory costs, and there is a cost price. And the only difference between an industry which isn't insurance and insurance is that our raw material, our cost price, is going to be the burden of claims. And the burden of claims is not known ahead of time. When you sign a contract, you don't know what the burden of claims will be. So in fact, our expertise is focused on understanding this random phenomenon which lies at the heart of our business. That is why we are going to need to call on theory in order to try and understand the model or this real phenomenon and model it so that we can use the properties which will enable us truly to understand. And if we break down the premium into all its components, you have the taxes, the regulatory side, the operating costs like remuneration of the business providers, management costs, and then there's the first term, which is the premium, the pure premium. Pure premium is the load of claims we'll have to bear, and then there is the safety side, which is there to cover uncertainty as to the risk and volatility. We'll talk about this later. What we're going to focus on in the first part is understanding this random phenomenon and the tools that you can use to model it. So here you have an example, which is a very simple one. You can see the phenomenon at the top on the left. You can see that there are ups and downs. We don't really know in which direction the line will go. You don't see any logics underpinning this. A simplified image you might think about is the following. If we knew of all the interactions and all the physical models, all the things in the world, we could predict the future. But that is something you cannot do because there's too much data. It's as though between us and reality there was a sort of a sheet with holes, and we can see little points. That's what we call observations. And based on these observations of a random phenomenon, we try to understand how it behaves, in fact. What's really important to realize is that we're going to try to calibrate a theoretical model based on a practical phenomenon. We're not going to try to squeeze reality into a model that's not suitable with a shoehorn, so to speak. Here you have an example. Probably you'll end up in the middle, somewhere towards zero, rather than end up at +3 or -3 in this model. So if you want to try and predict things, you can base yourself on this. Now, if you continue, you have the blue phenomenon early on. Now it has been plotted as a distribution of probability. The distribution of probability is a very simple tool to see in all the interactions how many there are at a given value. And what you can see here is that between the left-hand side and the right-hand side, you have exactly the same phenomenon, but on the left-hand side, we do it with fewer points than on the right-hand side. That means that this will introduce the key property in this model. The more observations you have, the greater the stability. But you have to be careful, because this is where the real difficulty lies. This is why understanding the risk on our side, on the insurer's side, will be very important. In order to use this model, the phenomenon observed has to be homogeneous and stable. If you have a phenomenon that behaves totally differently 15 years ago as opposed to now, it's hard to see how things are going to behave in the future. What's really of paramount importance is our ability to build groups which are both homogeneous and stable, but at the same time large enough with a sufficient number of observations to provide some stability. So in fact, this is where in practice cooperation between actuarials, actuaries and underwriters lies. We need to cooperate so we can understand the phenomenon and reprocess data if necessary. We all know that in practice, phenomena are rarely stable over hundreds of years. So a change in the risk for a customer, a change in turnover, the purchasing of new activity, a change in contractual terms and conditions, that is where the two worlds really meet. Here you can see a normal law, which everyone is familiar with, a Gaussian law. In practice, it doesn't necessarily work like that. We're trying to model phenomena which in real life may or may not happen, like a claim. There may be 0, 1, 2, 3, 4, 5 claims. You're rarely going to have -5, -10, +15. So we use this kind of law just for practical purposes. And what you may have, and this is something you're familiar with, no doubt, is the frequency, the Poisson law, negative binomials for severity, log normal, Pareto law, and so on. This slide is the last one on the sort of teaching side. It's here to illustrate the models that are truly useful. Look at the curve at the upper left. What we're going to do is to have more values in the middle. So we'll be able to calibrate the curve fairly accurately in the middle. But to get a good vision of what happens on either side, well, that's where the model is going to fill in the gaps, so to speak, as we saw earlier on. We'll be able to use the properties of this model to understand things about the phenomenon. On the lower left, there are metrics. The VAR 99%, 99.5%, that's the distribution. The 200-yearly risk, that's VAR, and TVAR is about the same thing. TVAR is the average of what happens over and beyond this X quantile. And TVAR helps us to know whether the phenomenon will have a huge distribution tail or a small one. Will you lose a lot over and above a catastrophic level or very little more? It depends. That illustrates the importance of risk management, in fact. And there's something which is also a little bit more practical, the impact of scattering. When you look at what we said earlier on, and you look at the price and the average approach or price, you can see that the blue and the orange phenomena have behaviors which are very different. Orange is far more scattered, even if the average is the same. These are metrics which help us truly to foresee the risk. We're not always interested in the average. Of course, we can look at volatility. For example, when you assess counterparty risk, this is the kind of thing we have to try to understand, in fact. So Following this very theoretical introduction, we could take up a more practical case and look at the methods used in practice in pricing. This graph is very important because in real life, we truly have two kinds of models which are used. The first model, in fact, you choose the model depending on the phenomenon you want to look at. If you look at the blue phenomenon here, you can see that the blue phenomenon looks as though it's a phenomenon which doesn't happen very much but is very intense, whereas the orange phenomenon isn't that intense but it's very frequent. So if you try to characterize the blue phenomenon using an historic approach, you may well miss out on possible things. If you look at the orange phenomenon, you might say, okay, we've observed this for the past 15 years. We reckon we've pretty much understood what might happen. So should you use a model based on experience or based on exposure? In the model based on experience, you have to be sure you have enough hindsight to observe all the possibilities. And what you see in the orange phenomenon here is that as of 2005, there's a sort of a trend, and you really have to fully understand before launching into this experience-based model what the conditions were in the past and how they apply today, to be sure that you can process things properly. Owing to these characteristics, you understand that you can't use the model based on experience to price new risks or risks with a high return period. For those risks, it's better to use a model based on exposure. It remains a little bit theoretical, but we'll be giving you many examples later on. It's Alex who will do that. And these models are based on quite a refined knowledge of customer experience and exposure. And we can therefore create a scenario, particularly if we use several different methods. Here there are two slides on burning cost. Everyone can produce a burning cost. On the whole, it's just an average. But we really wanted to insist on this point because the burning cost cannot be used just like that without being careful about it. As we saw earlier on, the key that has to be checked is the real phenomenon being observed has to be homogeneous and stable, and in real life that's not at all the case. Look, for example, at the two graphs on the left-hand side of the screen here. You can see that for this particular client, there is a claims burden which increases, but not all that much, but exposure increases a lot. So if you apply the burning cost just like that, you might miss out on this phenomenon, because what you see is that on average, per unit of exposure, you have a burden of claims which is dropping. So if the customer the day after, or when he renews his contract, he has an exposure which drops, then we'll have to take account of that trend. So here we're really going to talk about all the information we need in order to calculate a good burning cost. First of all, you need to have a very up-to-date vision of claims. You need to have a lot of data about the claims. Obviously, claims can evolve. Even if the marine approach is a fairly short-term one, you can use claims over the year. You still have to develop things, and you can use the same methods. And it's good to do this taking account of the customer's situation, because you can take better account of the customer's, the client's specificities. If you're dealing with a phenomenon which is very frequent, it's very important this. There's the chain ladder method, There are all sorts of methods one can use. The chain ladder, Burnwhite or Ferguson, you really have to understand how things worked in the past, how they will in the future, inflation. All these are parameters which are very important. Earlier on, we talked a bit about exposure. Exposure is also extremely important because it enables you to know or to understand whether there's a physical value which is linked to a client experience. The hypothesis in terms of burning costs that you really need to know about is the following. For emerging risks, you cannot use this because it has to be based on the idea that the past or the future will behave like in the past. So now we'll go on to a more practical side of things. The information that we usually ask in order to be able to understand this phenomenon and to process data properly. We have to understand the kind of risk over time, how it's evolved. Has the company now indulged in new activities? What about the structure? Are there groups per guarantee? We have to look at the claim index and triangle with as much data as possible about all the possible claims. As always with pricing, you have to propose the most suitable pricing for that given client. The aim is not to create a sort of portfolio of prices. One might also add that actuaries, underwriters have a good vision of risk and the distribution of claims. That helps us to really propose suitable structures in terms of franchise, deductibles, and so on. So here, we're going to change completely. We're going to leave pricing based on experience and now look at exposure. Before Alex takes over, we're just quickly going to explain why pricing based on exposure is so important and why one shouldn't limit oneself to a portfolio approach and return period. Look at this. Look at these two clients here. The left-hand client puts all his goods on different boats, and the right-hand one puts all his goods on one boat. You can see that the risk profile is totally different. The left-hand client may have more claims, but they'll be smaller, and on the right-hand side it's quite the opposite. Whence the need to have a maximum amount of information in order to price based on exposure, and this would therefore be as relevant as possible. Here we have several examples of pricing based on exposure. There's several methods you can use. Here's a cargo example, and then we'll use a hull example, and then we'll use a sort of all-round example. So pricing based on exposure, it can be based on Pareto distribution. We have the theory of extreme values in mathematics. The idea is to try to find laws which work well with extreme phenomena. There's several systems. You have the Pareto law, which is very simple. What we have for this kind of pricing is the following. For this client in particular, we have observed the situation over 10 years. We've observed a number of claims, but we don't know what's going to happen after this return period of 10 years. What will happen between 50 and 5,000 claims? We need to get a maximum amount of information concerning client exposure, and then we're going to define rare scenarios and calibrate part of the curve with the claims observed and the rest with the scenarios. And here is a second example. This is a hull example, total loss. This is not, well, it is linked to client exposure, but calibration is not linked to the client. Here with this model, as we saw at the beginning, we try to create homogeneous stable groups which have the most data possible. We agree that shipwrecks don't happen very often. So what we're going to try and do, of course, is to look at all the data in our portfolio and create groups of boats, vessels, which behave similarly in terms of total loss. In this example, we took the kind of boat and its age, but depending on the characteristics, it can be the power of the engines or something else. With this pool of data in these groups and curves, we've observed so many vessels over so many years, we can say there's a probability of total loss every so many years or what have you. Because we have these groups, we can refine the analysis, and instead of putting the same probability for all clients, we can say, no, there are different profiles, and it will depend. And then, depending on the characteristics of the client's vessels, we can calculate the probability of total loss, build up a scenario based on client exposure and a much wider exposure. Now, perhaps I'll hand over to the specialists in grander models. Thank you. We'll perhaps take questions in a second stage. So, Alex, over to you for the second part, which focuses more on cat exposure and pricing. Thank you, Laurence. Cat means catastrophe. What's a catastrophe? With global warming, we observe this fairly often. Last week, for example, after bad weather in France, there were cities that were flooded. That was a catastrophe, a disaster from a social stance. It led to huge losses for society. For reinsurance, CAT is defined as an event which causes just one risk, a very severe event. CAT accumulation is important for insurers and reinsurers. For insurers, in underwriting, you have to factor in accumulation, otherwise there'd be major losses. It's important for society as well, and for capital, for each insurer. Why is it important for the reinsurer? Because the products and the solutions offered by reinsurers are often in this framework. It's a reinsurance solution which helps the insurer better to cover the buildup of CAT. A CAT event could be caused by various things. For example, natural risks, hail, storms, or human error. In the marine world, the accumulation is more difficult to model for several reasons. First, because exposure is often unknown. All the goods transported around ports in the world, it's difficult to track them, for example, and the values are often difficult to compute. It's harder to get information on the value compared with other kinds of insurance and so on. In the marine world, I'll give you some examples of accumulation. Accumulation in ports and airports, accumulation of hull and goods, cargo, claims in the past. For example, Beirut recently. A second example is big commercial vessels which may transport a huge amount of goods, and of course they are a source in themselves of accumulation. And then warehouses, storage with a major accumulation of goods. For example, in 2015, in Shenzhen, the economic loss was $3 billion because of the accumulation of different kinds of goods. Last example, shipyards and marinas, where there are a lot of boats. In shipyards, the hulls are often being built, and all the fire breaks haven't been installed, say. So that is a big risk when it comes to fires. For yachts in marinas, the yachts are all jammed in to the marina, and one fire could cause multiple losses for the insurers.
Laurence.
So moving on to Laurence. Yes, this is a slide that we added before we talked about the CAT model, which is an RMS model, I think, here. This is a way to show you what the CAT model is going to run on and how in practice it works. The model, what it's going to do, you're going to input a list of insured goods, which is not always easy to determine, as Alex was saying, because especially in marine, you can have something that is less stable than in damages. And once the software's got a list of all insured values with their construction features, their vulnerability, their location, it's going to run a series of catastrophic events that are possible. So if you look at it here, the most interesting figure is a sort of this series of concentric circles at the top right. This is an earthquake footprint, and you can see that depending on proximity with the epicenter, the ground shifted not necessarily in the same way. So based on that, the software, well, there are different names, not just RMS, but the software is going to simulate a very large number of such potential events on the portfolio and therefore infer a loss distribution. Here, you can also look at modeling made by the RMS software by way of example to model exposure and cargo event and CAT events for cargo. For cargo, there are two types of exposure. The first type is static exposure in storage or warehouses where the address is very well known with the value of the objects. Secondly, you've got unknown exposures, very often in transit. All the goods that are transported by vessel worldwide, very often their exposure and the location of exposure is unknown. First of all, you need to take some assumptions about these unknown exposures, and you need to quantify the CAT risk that is applicable. Here in particular, you've got so-called natural CAT risks, or natural disasters such as storms, floods, and so on. You can see at the bottom left, the cargo vulnerability depending on wind velocity and type of cargo. So there are different types of lines. On the X, well, it's very small to read it, but it's wind velocity. And on the Y-axis, you've got the destruction rate. So, of course, the faster and the more violent the wind, the higher the destruction rates. Why are there so many lines? Well, cargo cat modelings depending on 3 factors. First, the type of cargo. Are these automobiles, bulk, goods in containers? And the type of cargo has a significant impact on the modeling outcome. Another more important factor is the type of storage. Are the cars stored on a lot outside? Are they covered up in a warehouse? Are they secured? All these types of storage have an impact on the vulnerability in our model. And thirdly, of course, the type of event, the type of natural disaster is going to have a significant impact on the outcome, such as a hurricane in the US, and that's not quite similar with a storm in Europe. The idea behind CAT modeling is, first of all, to identify the exposure, static and volatile, and then identify the potential applicable CAT risk. And then, as Lawrence explained, you run simulations with all these parameters in order to build a list of events called event loss table. That's a table of all potential events, and based on these outcomes you can do some pricing for individual risk and reinsurance treaties. So the outlook. Under this heading, we want to discuss the main trends related to pricing, especially because of big data. This is an example from a provider called Windward. You've got 2 boats on the slide, Ingrid C and Banus A. They look very similar on the pictures, and if you look at the technical features, they've got the same type of boat. The size is similar, same flag, same owner, same age, so you get the feeling that the 2 types are identical, so normally there shouldn't be any distinction in the pricing. But with some software and databases that use that, you can get information about the ship's behavior. For instance, here you can see that Banus A at the bottom right. The navigation distance is a lot bigger than Ingrid C. In this case, logically, there's a higher likelihood that Banus A is going to face a problem and potentially run into some damage. So now different types of databases are available with all big data and data science techniques. You could collect a lot of data, such as weather, ship routing, temperature, ship speed, all sorts of information related to marine navigation. It's a bit similar to the telematics systems in the automotive world. So for every ship, you determine its own figure, and then you do very specific modeling for it. Once you've got these data, in terms of pricing, we could fine-tune the model with these ship behavior scores. You could better distinguish good risk from bad risk and apply the scoring in pricing. That would be very useful. With the scores, we improved underwriting results with these data. And last but not least, very quickly, because we've already talked about that several times during the presentation, we wanted to talk about another 2 things besides big data. One of them is related. First of all, there's the notion of the inclusion of volatility, because as you know, Solvency II, which is the European regulation on insurance, requires that you set aside a certain amount of capital, the SCR, and this amount is the amount that you would need to face a bicentennial shock. So a likelihood of 1 out of 200. It's calculated by risk management models, and based on the specific risk in the insurer's portfolio, it's going to require more or less capital. There's also a part of this necessary volatility that is taken into account in the pricing in order to remunerate the immobilized capital. So when you look at things, you come back to an equation for premiums. You've got the first term, which is an average, and the second term has to be about volatility. And then the second part that we wanted to talk about is fully related to what Alex explained about big data. With big data, the types of problems you could run into right now have to do with depths of data, because one thing you need to realize is that the historical data we're interested in were not always stored in the most easy way to use. So if I take an extreme case, if you've got data since 1900, but it's a spreadsheet within a single cell, you've got the price, the cost of claims, the type of ship, it's not going to be very useful. So there's also a lot of work to be done on nomenclature for data storage and the recharacterization of historical data. Well, yes, indeed. In the case of data science, very often 90% of the time is spent on cleaning up and collecting the data. Thank you so much to the both of you for this a really exciting presentation, because you can see very strong substantive change on issues of pricing, exposure, and the understanding of risk. It's a small revolution that is happening in the world of insurance and reinsurance that's been happening for a few years, and that should continue. So my first question is for Frédéric. How does a broker or a client at some point get the same level of understanding of risk to discuss? We can see that you've gone a long way. There's no going back because of regulatory constraints and capitals that need to be provided to face the potential losses and the big data techniques. So in the chain, we need to have the same level of understanding. Well, first of all, I was a bit impressed by the demonstration made by Laurence and Alexandre. That is very interesting, really exciting. And one thing to take away from that you were explaining, Sylvain, now we are moving, well, there has been a lot of professionalization in the business, and we have data available. We were talking about big data. Now we can have very fine, detailed analyses. The complexity is to go from your level to that of the insured. How can you provide credible information so that eventually the insured party can understand? That's the real issue. Most of the time, when a policyholder does not accept pricing, either because they don't have the budget to pay for it, or because they don't have the explanation. If you explain the thought process, things can be different. And then in terms of budget, accept it or not for a policyholder, well, that's about the levels of waiver and custody. Well, you get your client to think, as a broker, these are my clients. Well, should you keep some risk? And if you keep some risk, then you need to have an insurer's view of things, because you'll be keeping some risk. What is essential now, I think, is that the work that you're doing as actuarists working on pricing should be rolled out and explained to underwriters, and from underwriters to brokers. Everybody would benefit and become more credible. Nothing's more tragic than when very often you see brokers or advisors deliver tables to clients with this company, this price, such company, such price, and then you can draw your own conclusions. No, it requires a lot of explanation. There's a lot of intelligence behind it. There are reasons that even the policyholder is going to be interested in. They are going to be even more interested, as they could influence their pricing by keeping a bit more risk, by taking preventive measures, without necessarily there being some constraint from insurers. Because at the end of the day, if the policyholder understands, the insurer is going to win as well. So what is essential is to pass on data and try to make sure that the information chain is as relevant as possible. If you see now, well, it's all the more true as we're going through complicated times. I mean, that's not news for you. We've seen the markets in the last 3 or 4 years being, well, we've seen the market increase premiums very strongly, but if you also look back, 10 or 15 years, it's also interesting to show insured parties where we started from and the increase and decreases. That all puts things into context. So yes, you've got an essential role to play. You're not going to be the broker's contact, but your role is essential to explain to underwriters, those who are in contact with brokers, how it was calculated. We should never deliver a quote before without giving the underlying data and what your belief is based on. So the message is that we should move from something transactional to something a bit more elaborate with more discussion. Does that mean that brokers should equip with some actuarial analysis capabilities? For us at BC, we've got actuarists, we've got teams of actuarists in major risks involved, both for damages, liability, and in areas that are both marine but also others, non-life and major risk. So becoming more equipped is a necessity. Now you need to have teams of actuarists, and our customer relations managers, those who are in contact with clients, once they use actuarists, they become essential. You get all the arguments. You simply need to put things in context, take this or that data point, and things become simpler. I'm not saying they become easy, but they're simpler. Yes, Frederick, that's a very good comment indeed. Actuarists as insurance technicians sometimes seem to be numbers people, but part of our job is to explain to underwriters or brokers why the pricing has changed. Well, for a whole, your price is higher this year because you navigated more last year than the year before. And also with concrete data, you can explain the change over time. That way the client and the broker can get some feedback for the clients, and then the clients can understand why. And as you were saying, you can improve the risk quality to improve prevention. That's a win-win both for the insurer and for the client. And what I can also see by experience at AXA XL, more and more we've got this dialogue between pricing and underwriting, where underwriters are more and more skilled about how models worked, and so how can they grasp them and what information they need to ask for. And we have better skills in terms of risk understanding, so we can build more relevant models. So there's a real dialogue that's been initiated, and that makes the dialogue all the more relevant with underwriters and brokers and insured parties, because let's not forget that eventually they're the ones paying, and reinsurers as well. Yes, of course. I'll come back to this example of data, and now for whole insurance, we had very little information for a very long time to price the whole insurance, the age of the captain, and the color of the ship. But now you've got 500 data points about any given vessel. Maybe that's not all relevant, but the model is changing, and access to data no longer requires that you have a chat with the client, because you've got access to data without asking them for their opinion, because there are data providers and companies that can process the data and deliver a risk that you can include in a pricing model. So in my view, that's a real sea change in the nature of evaluation of risk and the discussion with brokers and customers. Maybe in the future you could imagine that there's going to be whole insurance pricing that is fairly brutal because it's completely uncorrelated from the discussion. Now the data give you a price, and you're going to have to deal with this price. Well, yes, but then you've got cursors that have to do with the conservation of risk, and so insured parties need to be mature about their risks. And there's another aspect that you can see: parametric insurance. At BC, we've invested a lot in this type of insurance, and that can be deployed to all sectors of insurance. And I'm not saying that the other types of insurance are not smart, but this is nothing but intelligence, because these are facts put into context that trigger guarantees. And as you very rightly said, data can lead to some fairly violent realities. And to come back to the development of parametric initiatives, you can see that in all sectors throughout the world, with value propositions that are fairly simple, parametric, but that requires a lot of data that you need to understand. And so you can offer a very simple to use product, an easily adjustable product, which limits operating costs. Maybe one question: is good pricing fair pricing? Is fair pricing with the right information available? But you also need to sell. I think these are two different things. The pricing given by actuarists is not something that we can act on as salespeople, because it's a measurement of the information that we've got. So you can say, we've got this, so we think the reality is this, and then the commercial discussion is different. It's very good to know where you are, so that you know how low or how you can go. The marketing discussion is different. That sets the bar only. Can you fully understand the risk in your model? In the future, can you say that your model is sufficiently precise and accurate to be self-sufficient? It can be good enough to predict to so many decimals. Marine risks have changed a bit, but you're not talking about new risks. What's the current level of maturity of models? Well, it depends. It depends on the models you're using. There are different types of models. And in the maturing of a pricing model, there's the first intention, a very simple model with clearly defined hypotheses that you've got a good overview of. Then there's the second type of model, which is the worst, because it's complicated pricing with a lot of hidden assumptions, and you have a lot of safety margins that you may not be aware of. And then there's a fully mature model, which has fully controlled hypotheses that you understand end to end, and where you no longer really have any uncertainties. So that depends on the company and the sector of business and how far ahead they are with models. I agree with Lawrence. Now in marine, it depends on the type of model. For attrition losses, we're fairly good, but for catastrophic models and unknown risks, such as cyber risks in marine, that's still an area to be explored. That's why now at SCORE, there are a lot of task forces studying these risks that are potentially present but not yet actualized. Black swans, then. Yes, absolutely. Your panel led to a lot of responses, and you've already partially answered some of the questions. A lot of questions keep coming back about the share of these studies in the final pricing, and in particular, the impact that this has on a competitive market. Wouldn't there be a risk of losing profitable business because of pricing? A lot of questions are about this. Well, because of pricing, profitable business could be lost. Well, that means that there's uncertainty about the pricing which doesn't align with reality. Well, that's a moment when the model cannot capture reality, because there's another issue. If a business is profitable, generally there's a potential strategy which would be to take on a highly volatile risk with big peaks. So most of the time it's profitable. And so the only moments when it's not profitable, it's really not profitable. And so the pricing model should try to show this and give a mean approach, try to show what the behavior of the risk is, but then it's an underwriting decision about portfolio management. But it's like on a plane. If you don't have good measurement of where you are, maybe it's better to be a few feet higher and lower. You need to have a rough idea of where you are, and then you can go a bit higher or lower. Maybe not all businesses are priced at the ideal price, but it's all about portfolio management. Sometimes you can accept businesses that are well priced and others that are not so well priced, and the overall goal of portfolio management leads you to the balance that you want. I think it was also maybe a question about the final client. The questions are about this. Maybe you could isolate an insurance company on a very competitive market that would be held back by pricing. Yes, but are companies entirely run by actuaries? There are underwriters and people in contact with the market. And there are also brokers who can think about things and provide the thinking and the number of elements that can help move things downwards. Here we were saying that pricing can be a violent realization up or down. When containers arrived, that changed things completely. They didn't used to be containers. That reduced a lot of accidents, and that reduced premiums a lot. That's something you should anticipate. It's all about anticipating on several factors. And to answer your question as well, I don't think that a company could be isolated now. It's about regulatory constraints on solvency, and any company that has a license to provide insurance policies has an obligation to provide information reserving or capital, and that is based on a model. You can't do this without a model. You can't be isolated for the long term because you're too expensive. I don't think that's possible. And given the rise of models, with hindsight, were you able to compare pricing 20 or 30 years ago that didn't use such advanced pricing models with your models now? No, I haven't done it personally. We know that for some branches in marine hull, the market was not really favorable in the last 10 years. Pricing was not high enough, so that probably answers your previous questions. It's difficult to gauge the profitability of an individual contract because for years the market as a whole was not profitable. That's a question we have. Why was there such a difference in viewpoint between actuaries and underwriters? Sometimes underwriters are under marketing pressure, and because there was a lot of capital on the market, and so that could create a vision bias on pricing as set by actuaries. But with communication and explanation, that's the best solution to explain and to overcome these differences. Thank you so very much for this discussion and this information. There was a lot of response from the audience, but this is the end of this discussion. But anyway, thank you very much. And now a partner break.